Good afternoon. Welcome to Micro Trading for a Living with Oliver Velez. That's me. For those of you who are not quite aware, I am the author of the best-selling Tools and Tactics for the Master Day Trader. I'm also co-founder of Pristine.com, which today is considered to be the premier educational resource for active self-directed traders. Just to give you an idea of how phenomenal of a revolution that we actually find ourselves in, Pristine.com, of course, was formed about 7 years ago in my basement apartment with one client. Today, 7 years later, Pristine has a worldwide following of 88,000 that spans over 62 different countries. If there is one message that I feel it's imperative that I leave you with today, it is this: that make no mistake about it, long-term investing is dead. I'll repeat that. Make no mistake about this statement: long-term investing is dead. Today, we live in a phenomenally different time. We do not live in a world that in many cases our parents lived in just several decades ago. We do not live in a world, certainly do not live in a world that our grandparents lived in many decades ago. Today, we live in one of the most revolutionary times in American history, in worldwide history. Phenomenal technological advancements today change the world every single 8 months. 8 months, the world from a technological point of view is completely different because of this radical change, because of the fact that the CEOs of various behemoths today like Microsoft and Sun Microsystems and IBM and companies of that nature, because they have to be frightened of the 18-year-olds and the 21-year-olds in their garages, we no longer can intelligently approach the market from a long-term perspective. Now, this might be a very difficult pill for many of you to swallow. It's a message that, quite frankly, the vast majority has not only never heard of, but when they do hear about it, they don't accept it. But I will tell you that parts of 1999 and certainly virtually all of year 2000 has driven this point home. That over the last 8 months, 4.5 years of profits were completely wiped away. In some cases, over a decade of profits were wiped away inside of 8 months. Today, the long-term investing approach to the market, the approach that I call the Rip Van Winkle approach. You know, that's when you buy a stock today, you take a nap for 5 or 10 years and hope everything is okay when you wake up. Well, that is becoming increasingly a very unintelligent way to approach the markets. 4 years ago, the average holding time of a stock was 4.5 years. Today, it's 4.5 months. Tomorrow, it'll be 4.5 weeks. The next day, 4.5 days. And for some of you very hyperactive types, maybe we'll get to the point where it's 4.5 seconds. And that brings me to my topic today, micro trading. Micro trading is a very professional style of trading. It is not for the masses. As a matter of fact, I'm willing to bet that it is not for the majority of people in this room. It is one of the most irrefutable facts about trading that 85% of the people who try their hand at micro trading for a living, 85% fail within 6 months. Of those who do survive beyond the first 6-month incubation period, that 15%, 50% of that group is gone, eliminated, wiped out inside of 12 months. So obviously, clearly, those chilling statistics don't paint a very encouraging picture. In fact, what it does drive home very clearly is the fact that the odds are phenomenally against most individuals who try their hand at micro trading without the proper education. Today, my job is to help you beat the odds. Today, my job is to provide you with a variety of tools that will give you the edge in the micro trading world. And I will tell you that if you are one of the smallest, or if you are one of the individuals who actually make it or become a member of that much smaller group who actually succeeds at micro trading, you will never have a financial worry again if I have my way. Because this style of market play is the true professional approach to the market. The average holding period of a NASDAQ market maker is 4.5 seconds. The average NASDAQ market making firm earns over 125% a year. The average holding period of a New York Stock Exchange specialist is 4.5 minutes. Average New York Stock Exchange specialist firm earns over 275% a year. Meanwhile, the heroes that are presented to us, the long-term heroes, their average gains, if they're very good, are 11 to 15%. The true professional approach to the market is a micro trading one. And I will tell you that the micro trader can enjoy a much greater degree of accuracy than his longer term brethren. And I want you to think about this. If I were to ask you, where would you be next year, in this very month, on this very day, this very hour, this very minute? You would have absolutely no idea. If I were to ask you where you'd be in the next 5 minutes, you'd nail it every single time. Same thing works for the stock market. Your accuracy to predict what a stock will do, where a stock will be over the next 2 minutes, over the next 5 minutes, over the next 10 minutes is a lot better than your accuracy in terms of guessing where the stock's going to be a year from now, 2 years from now. But still, without the proper tools, micro trading is nothing more than a quicker way to annihilation, financial death. So again, my job today is to move you into this arena and to equip you with the proper tools. So shall we begin? Let's do it. Okay. Introduction. I'm going to start off just to make sure that we're on the same page. We're going to go through some basic technology and we're going to get the proper tools under our belt, and then we're going to put these tools together, and I'm going to show you that there are some very powerful micro trading events that happen every single day and gives the astute market player the ability to extract income out of the markets daily. These events happen numerous times every single day. Our job is to learn how to identify these recurring events and to design a trading strategy to exploit the event. There are 4 trading styles: core trading, swing trading, guerrilla trading, and micro trading. 4. Now, this is not long-term investing. That's a completely different animal, a dead one. Okay? This is the trading arena. There are 4, according to my philosophy, there are 4 styles of trading: core trading, swing trading, guerrilla trading, and micro trading. These 4 trading styles make up 2 broad categories of trading. The 2 broad categories are wealth-building trades and income-producing trades. Obviously, the wealth-building group of trades is designed to really take large chunks of profitability out of the market. It's that trading style over, a slightly longer period of time that can truly build wealth if you become astute at those styles. Then there's the income-producing style of market play, which is designed to basically extract very small but frequent profits out of the market several times a day. So you have wealth building and income producing. Let's delve into those. The wealth building style is comprised first and foremost of core trading. Core trading is a style of market play that covers a holding period of weeks to months. The core trader attempts to capitalize on an entire trend. The core trader is not concerned with day-to-day vacillations in the individual security or stock, as long as the stock remains in its core trend. Core trading covers primarily a period of weeks to months. This style of trading is actually the new form of investing. It is the style of market play that is attracting literally hundreds of thousands of new participants every single quarter. The core trader typically uses weekly charts for his or her analysis, and as I mentioned before, attempts to capture the entire weekly trend. The line below primarily says that core trading is best applied to the overall market. It's best applied to broad averages and indices. Items like the spiders, symbol SPY, the diamonds, symbol DIA, the QQQs. The diamonds obviously are vehicles, is a vehicle that primarily tracks the Dow. The spiders, symbol SPY, is a vehicle that tracks the S&P 500. The QQQs, a vehicle that tracks the NASDAQ 100. So core trading is best applied to broad indices or sector groups. Now, here's a chart. Here's a core trading chart. This is a weekly chart of the Internet Holders Trust, symbol HHH. If you look very carefully, you'll see that over a series of 8 to 10 months, the Internet Index has been in a vicious downtrend. Note that the moving averages, and we'll get to moving averages very quickly. Note that the moving averages have been sloping downward in a very vicious manner for the past, 6 to 7 months or so. The core trader would attempt to ride this entire downtrend, to profit from this entire downtrend as long as it is a core downtrend. The definition of a downtrend is lower highs and lower lows. So the core trader attempting to capitalize on this multi-month decline in the Internet Index would remain short, for instance, the Internet Index as long as that pattern existed, as long as every single rally falls far short of the last rally on the weekly chart, and every single drop drops lower and further, deeper than the last decline. As long as that pattern's in existence, as long as that pattern's not broken, the core trader remains short. The next wealth building style is the now popular swing trading style of market play. Swing trading covers a holding period of anywhere from 2 days to 5 trading days. Now, many of you have heard me preach the swing trading gospel. I helped to popularize this form of marketplace 6 years ago. Swing trading is a very unique style because it attempts to capitalize on a very overlooked market niche. And what's most interesting about this market niche is that it is too short for institutions to take advantage of. They're typically too large and cumbersome to really maneuver in a 2 to 5 day holding period. At the same time, it's too lengthy for those very active, schizophrenic day traders. The guys in front of the monitors with blurry eyes and bad bladders because they can't take a moment to use the restroom. They would never dream of holding a stock overnight. So the individual swing trader who operates in this 2 to 5 day time frame is literally operating in a gap, in a market niche that is devoid of a big part of the competition that comes from these two dominant market groups. If you become astute in the swing trading style of market play, you are alone. The swing trader typically uses daily charts and attempts to buy the dips, sell the rally. Now, unlike the core trader who wants to ride the entire trend and is not concerned with the day-to-day vacillations, as long as the bigger trend is intact. Unlike that market player, the swing trader says, I don't like pain. I don't like 5 days of pain. I don't like 2 days of pain. I don't even like 1 day of pain. I want to take advantage of a continuous 2 to 5 day move in my desired direction, and then I want to get off and do it again. The swing trader buys dips and sells rallies. The swing trader shorts in downtrends, rallies, and covers on dips. Move to the next. Here's an example of a swing trading chart. We're looking at a daily chart of Archer Daniels, symbol ADM. What we're looking at is a daily chart with two primary moving averages, the 20-period simple moving average and the 40-period moving average. I want you to note how smoothly these two moving averages are rising. Note that the 20 is rising comfortably above the rising 40-period moving average. I want you to also note that this stock, ADM, Archer Daniels, is in an incredibly powerful uptrend. It is making a series of higher highs and higher lows. And I also want you to note that the 20-period simple moving average is like a concrete floor under the stock. And it serves as a concrete floor not for several days, not for several weeks, but for several months. The swing trader attempts to come into the arena of ADM, of Archer Daniels, when it has a multi-day decline toward this rising 20-period moving average. This multi-day period of pain, this temporary selling, after 3, after 4, after maybe 5 consecutive bars to the downside, with ADM approaching its rising 20-period moving average, the swing trader attempts to step up to the plate and to take stock from someone who's selling it at the wrong time. Think about it. What the swing trader also tries to do is to ride the rebound and get off before the next decline. You see, the swing trader is not interested in riding the entire trend. The swing trader is not interested in suffering through 3, 4, 5 day setbacks. The swing trader only wants the party, and he wants to leave before the party ends. That covers the wealth building style. So wealth building covers core trading and swing trading. Core trading covers a period of weeks to months. Swing trading, 2 days to 5 days. Income producing is our next category. This is the style of market play that is designed to extract smaller but a lot more frequent gains out of the market. $275 here, $525 there, $450 here, several times a day. If you get really good at it, many times a day. Income producing style is comprised of two trading styles, the first of which I call guerrilla trading. Not the animal, but the warlike approach to the market, the hit and run approach. Guerrilla trading covers a holding period of anywhere from 1 to 2 days. This is the style that you buy a stock on Monday, you sell it Tuesday. You short a stock on Wednesday, you cover it Thursday. It involves one overnight hold. It's a style that a lot of our traders practice by getting in the last 10 or 15 minutes of the day with the idea of potentially profiting from perhaps maybe a gap open the next morning, or if on the short side, a gap down the next morning. This style of hit and run trading capitalizes on reliable overnight patterns, but only one overnight pattern. The guerrilla trader typically uses daily and hourly charts for his or her analysis, and again attempts to buy late day strength and short late day weakness. Because there is a theory, and it doesn't work 100% of the time, but there is a theory that strength into the close will carry into the next day. Weakness into the close will carry into the next day. Here's an example of a guerrilla trading chart. This is an hourly chart of ALTR. Altera Corp. We are looking at approximately 10, 11 trading days. Each bar represents approximately 60 minutes of trading. What we're looking at here is on our first buy, the guerrilla trader is attempting to buy this late day strength in the last few minutes of trading, the last 10 minutes, the last 5 minutes of trading, and wants to potentially capitalize on a gap follow-through to the upside the next morning. What you'll note the day later is that the stock gaps up, rallies several bars, then drops all the way into the close. The same guerrilla trader, understanding the guerrilla trading concept that weakness into the close more often than not continues its weakness into the following morning, would attempt to sell this stock 10, 15 minutes before the close with the idea of a possible gap down the next morning. But this is not a course on guerrilla trading. That's probably next year. Okay? Let's move on. Last but not least, the trading style that completes the income-producing category is called micro trading, the subject of this course. It covers a holding period from anywhere from seconds to hours. It does not call for holding stocks overnight. This style of active trading goes after small but frequent bite-sized gains. All right, the micro trader typically uses 2 time frames, not a weekly time frame, not a daily, but 2 dominant intraday time frames: the 5-minute time frame and the 15-minute time frame. All right, that's very important. Here's an example of 2 micro trading charts: the 5-minute time frame and the 15-minute time frame, and we happen to be looking at the same stock, AMKR, symbol AMKR. There's a 5-minute chart and a 15-minute chart. The staple for a micro trader is the 5-minute time frame. The 15-minute becomes important during certain parts of the day, and we'll talk about that very, very thoroughly later on. But the number one time frame, the window through which the micro trader virtually views every single thing that goes on in the market, every single security, every single stock, will be the 5-minute time frame. That is the staple. And what we're showing here is a 5-minute chart with 2 moving averages. And I think this is so important that you should write it down. That every single intraday time frame, and in our case, the 5-minute and 5-minute, the 5-minute time frame and the 15-minute time frame, will have 2 dominant moving averages displayed at all times: the 20-period simple moving average and the 200-period simple moving average. In fact, I do not consider an intraday chart an intraday chart unless it has those 2 moving averages: the 20-period simple moving average and the 200-period simple moving average, and they both should be permanently attached to your 5-minute time frame and your 15-minute time frame. The 200-period moving average is so powerful in the intraday time frame, and I hope I don't offend anyone who's serious about their religion, and if I do, it's certainly not intentional. The 200-period moving average is so potent, we have a nickname for it. It is called God. Stocks obey the 200-period moving average like we should all obey God. 8, 9 times out of every 10 times, the 200-period moving average will stop a stock dead in its tracks. If it's rallying up to the 200, you can bet your bottom dollar 8 times, 9 times out of every 10, the 200 will stop it dead in its tracks. If the stock is coming down to its 200-period moving average, you can bet your bottom dollar 8 to 9 times out of every 10, the 200 will stop the decline dead in its tracks. And we have a variety of micro trading tactics that are built around this frequent occurrence. Now we're going to move into the tools of the micro trade. All right? They are primarily, we have 2 categories of tools: charting tools and market timing tools. The charting tools we talked about, they're the 5-minute time frame and the 15-minute time frame. These are your 2 windows from the micro trader's perspective. We also talked about the fact that both of those charts must have the 20-period simple moving average and the 200-period simple moving average on them. Market timing tools include the NASDAQ futures contract, the S&P futures contract, the New York Stock Exchange tick indicator, the NASDAQ tick indicator, the New York Stock Exchange trend indicator, and the NASDAQ trend indicator. Now, that sounds like a lot, but it really isn't. We'll talk about them very briefly. I do want to just let you know that since this is not a market timing course, I will not be as thorough as this subject actually deserves me to be. But these market timing tools are very, very important. Let's talk about the charting tools first. Here's an example of a 5-minute chart. We're looking at a 5-minute chart of night. Keep in mind that each bar represents 5 minutes of trading activity. Note that we have a 20-period moving average and a 200-period moving average. We've talked about that already. Here's a 15-minute chart of the same stock, night. We're looking at about 2.25 days or so, maybe 2.5 days. And again, we have the 20-period moving average on this chart and the 200-period moving average. And if you note, night seems to be rallying right toward its declining 200-period moving average on the 15-minute time frame. Just to show you the power of these two moving averages, and again, they're not going to stop or halt a stock 100% of the time, but that's not what we're looking for. We're probability specialists as traders. All right, we play the odds. We look for something that happens a lot more times than it doesn't happen, and we just play the numbers and do it over and over and over again. What you'll find on this 5-minute chart of AWR, Arrow Electronics, is that on the beginning of this last day, there was a multi-bar rally in the morning, maybe 30 minutes or so, right to its flat 200-period moving average.